What is private equity, and what does it mean to exit a business venture through purchase by a private equity firm? Well, to begin with, a private equity firm is, in essence, any firm that raises money or capital from third parties in order to acquire an ownership interest in a business. So in essence, it's simply an investment fund. Private equity refers to venture capital funds, but oftentimes when you talk in terms of a private equity fund, you're talking about a much larger fund that has larger amounts of capital to expend, and they often seek to purchase ownership interest in businesses, to restructure them or to break them apart, or to enter into some type of merger or acquisition deal or transaction. So the reason this is relevant for business exits is that oftentimes these businesses purchase existing businesses, and these can be startup ventures that have reached some level of maturity model, and they are in some way capable of being profitable or have some strategic value to some other business. So the private equity firm comes in, purchases the outstanding business as a going concern. So they own the operating business. They generally enter into employment agreements with existing owners to stay in place to continue to run the business for a period of time. And after acquisition, during that time, they begin to undertake transactions to either break apart the business into more profitable business units, to combine that business with other business units, that is through some sort of merger or acquisition, to make the business more attractive or more profitable. But most commonly, they streamline the business. They cut out aspects that are not generating revenue as expected, or they cut costs by reducing workforce or shunning off product lines that are not producing, and things like that, to make the business more valuable, ultimately with the purpose of reselling the business for more money. If you've ever seen the very famous movie Pretty Woman, this is what Richard Gere in that movie did. He worked in private equity. He famously bought businesses, broke them apart, and sold the pieces for more money than the business was worth as a whole. Of course, this is not the only thing that private equity firms do. Oftentimes, once again, they add value by combining with others, and sometimes they follow that model of breaking apart or just streamlining operations and then selling the business. But in any event, this is generally done as a debt transaction. That is, the private equity fund has raised money from investors as part of it, but the purchase of the business is normally financed through investment transactions as well as debt transactions from third-party lenders. Oftentimes, these loans are secured by the assets of the business or by the ownership interest in the business itself, and these funds, again, are used to acquire the business and ultimately will be repaid when the business is sold at some point in time in the future. So it's actually a combination of equity investment and debt funding transaction, whereby the private equity firm purchases the business, streamlines it, breaks it apart, merges it, whatever, sells it later. But ultimately, any profit is achieved through selling the business for more money than it was purchased for. Pay back the debt first, and then anything left over is profits that's shared between the managers of the private equity firm and the investors in the private equity fund. So this is how private equity works and why it's relevant to business exits, as many businesses look for this type of acquirer when they are seeking to sell the ownership interest in the business and ultimately exit that business.